What's up, guys? It's Ron from Rohde Law, and in this video we're going to talk about my average hypothetical commercial real estate investor and specifically what steps they take on their journey to decide what real estate investment is right for them. Ron from Rohde Law, and if you follow this channel, welcome back. Thank you so much for supporting me along the way. This is going to be a very different video where I talk about the exact circumstances of what I would say is my average or prototypical investor who is just starting out. All right, we're going to use the example. How about this guy named Joe? He's a full-time engineer. He has a W-2 job. Let's say he lives in Dallas, my hometown. And he's tired of residential, or he's thinking about diversifying from $2 million in stock equities, right? S&P is at all-time highs. Maybe he's cashing out some of his NVIDIA stock. But the reality is, people that are looking to invest in commercial real estate, you have to have some assets. You have to have some money to be able to invest that is more than $50,000. It's more than $75,000. You cannot, and I'm not going to be one of those attorneys that tells you that you can invest in commercial real estate with no money down. I think that's incredibly difficult. It's incredibly risky. And for a lot of reasons, I don't think that no money into commercial real estate should be encouraged. So let's go back to my sample investor. This guy's name is Joe. And he comes to me and says, I'm looking for ways to invest in commercial real estate. So these are the types of questions that I'm going to ask him. First of all, property location. I think the biggest advantage that somebody has if you're living in a market that you're able to comfortably invest in is familiarity with the area, your ability to go drive by and do site visits, local banking, all of your contacts are here. There's just a lot of momentum to invest in your local market. So if you're in Dallas, I would say look in DFW. There are plenty of deals, there are great tenants, and the entry price is not so high that you're buying a $5 or $7 million deal for your first deal. That's not necessarily true for my friends in California, New York. Think about what you know. Are you familiar with infill locations? Have you seen development occur over time? Where have you noticed population increases? Because population increases some of that demand that lifts all tides. And in commercial, when you have a long-term lease, you need to know not just what are my rents today, but what are my rents going to be in the future? And population increase is going to drive that demand kind of regardless of supply to some degree. So if you live in the city and you know infill, invest in infill and don't go out to rural or tertiary areas. Second, what type of leasing are you comfortable with? If I have an investor who owns residential properties in the past, they're familiar with gross leasing. They understand the pain points of unexpected real estate tax increases or insurance increases. And so a triple net lease is very attractive for them. A lot of investors coming from residential or even multifamily, they want to pivot to a triple net structure, and that kind of limits or creates a focus on what type of properties and what kind of tenants will sign triple net leases. Type of hold. This is also a huge difference, and there is a big gap in my types of investors. People who want value add, and that might be buying a vacant or a partially vacant building, doing some improvements, bringing tenants in, signing new leases, and adding value in a very short period of time. And then they possibly want to exit that. They want to refinance or they want to sell in a short period of time. And so that's a tried and true, but it takes a lot of effort. And in my example, if you're a full-time engineer and you're working a job, you may not have the time for a lot of the work that is required for a value add. This may be heavy contractor meetings. This might be architect meetings, meetings with the city, building permits, costing, delays, all these sorts of issues that would arise on your perfectly laid out plan. On the alternative, there's a more patient investor. We call it like coupon clipping, or you want to buy a single tenant asset that just pays rent every month. You pay your taxes, you pay your insurance, maybe a little property management fee, but that's it. The investment is a few $100,000 into buying this asset that just pays you a monthly return. Everything is generally fixed. And so what I recommend is if you have a 5-year fixed triple net lease, you pair that with a 5-year fixed debt so that you know that your major expenses are covered and you can just kind of set it on autopilot. The value or the wealth creation occurs at lease renewal. When you're able to mark to market and presumably the rents have gone up, you're going to make a lot more money on your original basis because you control the real estate. You still bought it for that price. And I get it, financing, your rates may change, some of these other costs may go up, but on the whole, you've bought this asset at a fixed price. If the rents go up, you're able to realize tremendous value over that life of the lease. Diversification is also very important. When people ask me, how much should I commit? I say, well, how much do you have? How much do you love commercial real estate? And it's an important question because I'm somebody that loves commercial real estate. I don't want to say I'm an expert, but I know a lot. And so I'm able to commit a larger percentage of my net worth. Granted, I still have S&P. I still have plenty of stocks. I've got no bonds, but a little bit of fixed income stuff, but not bonds. So I have my primary home and that sort of thing, but I have a lot of retirement accounts. But if you're looking at carving a certain allocation, I don't think that more than 20 or 30, maybe 40% at most of your equities of liquid investable money should be put into real estate for kind of this first deal. So that's kind of a rule of thumb for how much to diversify what your existing portfolio looks like. Again, if you're pivoting out of residential, out of multifamily, and you're selling a building and you're pivoting or selling a business, that's perfectly okay to put a larger percentage of that or 100%. You're just changing the nature and the character of your real estate investment. But I think it's a move for the better. So market timing. I hear this a lot too, and I really disagree with, is this a good time to buy commercial real estate? The answer is it's always a good time if you're buying a right deal. And a lot of the individual factors come down to the motivation of the seller, the timing of their debt, maybe their personal portfolio has other issues. I think, yes, interest rates were high, although presumably they're going to be coming down. You can always find a good deal. You just have to be patient. You have to know what your parameters are, and you have to be able to act quickly when a deal comes up. Market timing is not really going to produce the biggest returns. Those are like 1 or 2 percentage points of return. Finding a good deal can easily swing the returns from a 20 to a 27% IRR. Financing, another big hurdle, and a lot of people don't understand how to proceed with the financing. And I get it. There's not a lot of resources, even on YouTube, right? Commercial real estate, you've got a lot of brokers. I think brokers, number one, have the most channels. You've got multifamily financing people. You've got a couple lawyers with commercial real estate channels and a couple of investors. And that's it, right? You want to go with the smallest bank that can fund your size of your deal. And I also ask, where do you keep your money? So Joe, you're here in Dallas. Where do you keep your money right now? Your checking accounts, maybe your home mortgage. Where do you keep your money? Because that's going to be the first resource to ask them about a commercial real estate loan. And you can go from there to see if they're interested in extending a loan. Finally, exit. And this is something that I personally grapple with a lot because there's probably 2 camps, right? You have a value add, get in, make money. If you can realize a gain after a year, long-term capital gains are critical if you're not doing 1031. But you sell because you're in it to make money and your IRR is basically going down the longer you hold it and you coupon. And the longer you collect rent, but the value has gone up, the lower your IRR goes. And so there's a theory that you go in, you do the value add, and you sell kind of opportunistically as soon as you can. On the other hand, and I'm kind of finding myself more in this camp, is once you go through the hassle and once you find a good asset, you find good real estate, good dirt, if it's cash flowing, that's kind of all you really want. In order to feel rich or to feel like you've made it, people just want monthly cash flow. And if you're holding valuable, appreciating real estate that is not much hassle to handle and you're getting reliable cash flow, why not hold it? Because then that creates these opportunities. I've owned this, I own that, I own this. and they say, wow, this property now is worth $20 million. And they say, well, yeah, I bought it back in 2020. And it's really incredible to think about the discipline to hold something and to make that commitment to fixing things, to building relationships with their neighbors, investing in the city. There's a lot of benefits that go with holding a property forever. And I think I'm a little bit more in that camp of I like really good assets. And if I believe in the location, I think the rents are just going to keep going up. And there's definitely people I know that are very successful, that are older investors, and they say, Ron, maybe I've sold 10% of what I own, but these tenants have paid for their building 10 times over. And I think that's pretty powerful if you think about that. You can refinance, you can pull cash out, you can buy other assets, but holding buildings as they go up in value is incredibly powerful. So to summarize, success in real estate really comes down to knowing your own goals, knowing your own limitations, and then setting out to optimize your return within those parameters. I think commercial real estate is not a fit for everyone, but if you're watching this and you have these questions and you want to get in, it all takes knowing your own goals and then achieving those. So smash that like button if you're still watching. Thanks for subscribing, and we'll see you next time.